Welcome to the ARMR Report morning meeting, ladies and gentlemen. Thanks for joining. This is our second day of the live look-in. We're going to do it all week leading up to, I think Friday is off, right? So we have 4 days of this. So I'm just sharing with you how we get our day started here at the ARMR Report every morning, either 8:30 or 8:45, depending on how quick I write. We sit down and we talk about what we think the market's doing, what our trading posture is going to be, and anything important off the research desk. So I'm going to share a couple ideas with you today. Don't forget, I'm sharing with you the ARMR Investing way. It's a 3-stage process. I've been doing this over 30 years. I'm trying to condense a lot of what I've learned into this simple approach to get rid of all the noise out there and help all of us become better stewards of our own capital. The ARMR Investing way is geared to protect capital first and then capture upside when windows open. Okay. So we build our whiteboard. That's our research. We do our fundamental research all the time. We use algorithms, swing trading and day trading to take positions and just determine when we add and subtract risk. And we use stop losses to tie it all together and protect ourselves. So the ARMR Report, right? It's about how I run my own money. Basically 3 different portfolios, kind of 4, okay? Strategy 1 being based on the whiteboard. We get our algorithmic entry point. We go buy our favorite names off the whiteboard. Individual investing, right? Trying to build net worth by buying, the strongest, most compelling growth stories coming out of every correction. That's the simplest way to explain it. The second ARMR portfolio is geared towards using the algorithms, swing and day trading of indexes and group ETFs. No single stock exposure, no single stock risk. Just using the algorithms, putting capital to work when the windows open, protecting capital when they close. We have our dividend-only portfolio. Not for this discussion today. We don't follow the same stop loss rules. We take a portion of our assets, we collect yield. That's for another day. And then, of course, our 4th portfolio is index only, using the risk monitor. So when I say risk monitor is red, you can be sure that that index-only portfolio, which only owns the top 7 indexes we have our algorithms geared towards, the S&P, the NASDAQ, the Dow, the small cap, those are the big 4, the momentum and the value either side of that barbell, and then the IBD 50, which is our innovator portfolio that we follow. So when we're risk monitor red, that portfolio is 100% cash. When it's green, 100% long. When it's yellow, somewhere in between, booking profits, raising stops. Okay. So the first order of the day. And by the way, whatever I'm about to share with you is how I run my own money. So obviously, you have to make your own risk tolerance decisions. I don't know your portfolio. I couldn't possibly tell you how to run it, right? So I'm sharing with you my experience. Take from it what you will that fits your personality, your risk tolerance, your goals. All right. So step 1, what's our trading posture coming into today? In any bear market, there are going to be gap ups. They're going to be 2-day face melting rallies. They have no impact on the overall direction of the market. Now we get 3 up days in a row. We start seeing volume coming in. We get confluence across the algorithms that institutions are buying. Hey man, I'm happy to go risk monitor green. I can't wait. All right. But in the meantime, I put this shirt on just so you guys remember the situation we're in right now. Risk monitor red, market looks awful, right? We're having an up morning. So let's don't get carried away with, is the risk monitor going to change? Should we start buying everything right now? All right. It's going to take time for this market behavior and this weakness. And if you follow me on Twitter, I just reposted a picture of market breadth and what's been happening. Now, I'm the first to tell you oscillators and market breadth and all that stuff means nothing without triggers. So if we're risk monitor green and there's some bad market breadth, I don't care. Give it some scope. It doesn't make a difference. All right. But when we're risk monitor red and the market breadth starts to implode, we can see looking back that that's part and parcel of a bear market. So I call this the stealth bear market. I say we're stalking a bear. The only reason why it's stealth is there's about 5 or 6 stocks in the big indexes that are carrying the whole market this year. the S&P, the NASDAQ, right? There's been mass destruction everywhere else. But those 5 or 6 stocks levitate, holding the indexes up so that CNBC can crow that the S&P is up this year, okay? But in reality, we're risk monitor red, and we're seeing issue after issue after issue show up that a stealth bear market's unfolding. And that's why I republished that chart of market breadth, because it's just another signpost, or let's put it this way, another paw print as we follow those prints to the bear's den. That's what's happening. So trading posture, I look to sell market rallies when we're risk monitor red. We gap up and go up and stall out. Boom, when it rolls over, I'll be looking to put a short on. Now, if the market gaps up and immediately sells off to close the gap and test the put wall, I'll be looking to go long. That would be a long setup. And this gets me to a new part of the ARMR report that I'm sharing with ARMR Insiders. So I just want to show you all an ARMR Insiders in case you haven't seen it yet. So when you log on to as an ARMR Insider, you click up here and you get these 4 basic tiles, right? Exclusive video, model portfolios, the whiteboard, and our risk monitor, okay? And then down in here, the captain's note, captain's log, I write this every morning. So what I've added here is a couple of tiles. What we're going to talk about today, obviously this is fundamental research. So when I'm listening to conference calls, talking to management, I'm posting what information that I gather, I'm going to be posting here. But chart diagrams, day trading, and past great winning investors, okay? So we can replicate what we see. The theory here is there are just so many ways the market can trade. We're talking about day trading now. Every morning, the market starts a certain way. Think about it like a football team. You got a playbook. You see the defense on the field. You call an offensive play, okay? So every day, the market can only do so many things. When we're risk monitor red, we can have gap ups in the morning, gap downs in the morning, and then how does it behave? If we see that play unfold, we get on the trade. Okay, so I'll just scroll through here and share with you what this morning's trade should be if we see it. And by the way, I'm building this list. So there's some of these plays I don't have in the playbook yet. But here's an example of what we'll be looking for today. Short setup, gap up and go. Reversal day. Okay, so the market gaps up off of a sell-off and tries to go in the morning. See that? But fails after an hour or 2 rally. Usually it's an hour, but this is actually about a 2-hour rally. When it breaks back below the VWAP, that's where we look to get short. And it leads to this. Okay? Gap up and sell in the first 15 minutes. Sometimes you get a gap that immediately gives way. So depending on how this trades, if it gaps and comes all the way down and closes the gap and sets up a bottom, I'll be looking long. But if it does this morning, where it gaps up, sells off, tries to rally, and fails, that's where we're putting a short out. Okay, so those are basically the 2 plays we're looking at. Now let's go over the playbook so I can show you how this works. Here's yesterday's trade. And this is going to dovetail right into the last part of this conversation. I'll answer any questions you might see. So yesterday's trade, long setup, risk monitor red, gap down day. That's what happened yesterday. Now this is actually, this is not yesterday's trade. See, this is a playbook play from a trade, and I think it was early. This is from December 14th. Okay. We had a gap down morning that set up 2 opportunities to get long. Okay. The first fails. The second setup, you buy, and it rallies into the close. So let's look at this approach and then go take a peek at what happened yesterday. Okay. I'm going to just show you the S&P, but it works also on the NASDAQ 100. Okay. So here's yesterday's behavior. We're at risk monitor red. We gap down in the morning. That's the playbook. It sells off at the open, sets up a double bottom that we try, and it immediately loses money. Now, why do we try this trade yesterday morning? Because there'll be times, and I'll add it to the playbook when we see it, where we get the gap down, the quick double bottom, the whole thing rips higher to close the gap. And that's a wonderful trade. So I always put that out. The risk to reward's perfect. The reward's huge when that trade works, and the risk is minimal. Okay. Then we see over here the second trade setup. And it sets up from 11:30 really to right there. That's the trade. 11:30 to 1 o'clock. Double bottom below the VWAP, closing above the first standard deviation with those couple yellow bars. That's the entry point. Rallies back up to the put wall the rest of the day. So let me get to a particular topic I want to share with you before I get to any Q&A. Whoops. All right. There we go. All right. If somebody doesn't make money on yesterday's trade setup, the only reason is because of execution mistakes. So there's two ways when you're day trading, you're going to lose money, right? These are probability algorithms. So obviously they're not 100% right. There's going to be trades you put on, you lose money on. There's two ways to lose money. One, the probabilities just go against you. And we thoroughly accept that as a trader. We understand that happens. Nothing to do about it, nothing to worry about. If you have a strategy that works a significant amount of the time, you don't mind if you take a loss every now and then. It's part of the process. But the other way to lose money is through human execution error. And that's something that we can address. That's in our power. You never want to lose money, and of course you will, but you're going to work at this your whole life as a trader, okay? You don't want to lose money because you get in the way of the trade. You have to allow the trade to do what the trade's capable of doing. And you have to get yourself out of the equation. Emotions, fear, greed, whatever, ruin trades. So while we accept the occasional loss because it's a strategy that's probabilities, what we don't accept is human interference through the execution process. So I share with you, and I do this periodically. I go back, I look at all my trades, I crunch numbers deep into the night, okay, because I'm obsessed that way. And I see over and over and over again when I do this, and I particularly apply it to my execution, like what are the things I'm doing that are working and what are the things I'm doing that aren't working. Statistically speaking, I'm going to share with you 3 things that improve performance every single time I run the numbers. So you say to me, well, why don't you do it all the time? Because it's very difficult to execute this way. It's just human emotion. So we're going to strive every day. It's like the morning mantra to go over these execution processes. So we do it every day. Here we go. I'm going to share it with you. And of course, I've written this for ARMR Insiders to see in the captain's note today. So again, we can go to the captain's log. You guys can all see this. All right. So you can grab a pen and a piece of paper if you want to write it down, but you could just go to the captain's log and you'll see these 3 things we're going to talk about right here. Okay. Number 1, the same position size on every trade is critical. A human can't possibly come in and determine from one day to the next the size of the position, because that's based on emotion. And I guarantee you, just go back and look at your trades, you will always overweight the worst trades and underweight the best because fear and greed get in the way. I'll give you an example. The best trade last week was the Fed trade. The Fed makes the announcement, the market has this violent rally, pulls back, and then skyrockets. That volatility, that fear based on what the Fed just said and what the market's going to think might make you put a smaller position on, right? Which is, of course, the best day to put a big position on because you're going to have a huge gain at the end of the day. but you'll put a smaller position on because you don't know this, you don't know that, maybe this, maybe that, the news, da, 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 da. So what I'm telling you is whatever's the maximum position size that you can handle on a Fed day needs to be the same size every day you trade. So if you say to me, well, I can't put that much on a Fed day, it's too much risk. That's fine. I'm saying whatever you put on a Fed day, on that particular day where fear is guiding your position size, that's the position size you should use all the time and execute every trade that way. And over time, you're going to discover, well, okay, I'm not putting enough money to work. My strategy is great. I can be making a lot more money. All right, so you'll bump up your position size over time as you get comfortable. But the size has to be the same over and over and over again to get the human emotion out of that decision. That's number one. Number two, the entire position must be put on at the start of the trade based on the ARMR day trading way. We don't scale into a position. We don't buy as it goes up. The reason is we're booking profits as it goes up. So if you put on a small position at the trigger bar and then it starts to work and you get excited and you start layering on as it's running, you're reducing the profitability of that trade because now your cost basis is going up. And by the time we start booking profits, I mean, literally, but by the time you're adding to your last piece, we might be selling some right there. So you have to have the courage to put all the capital to work on the trigger bar closest to the stop at a position size you can maintain and manage on every day you trade. And the third piece to this process that will make it a bit easier. This is a big introduction. I'm introducing the two-tiered stop approach. Now, I've looked into this before, and it's definitely the way to go, and it's hard to execute. So, excuse me, I'm going to walk you through it. Do with it what you will. Statistically, every time I run the numbers, I run the algorithm, and I employ this process, the profits go up every time. Okay, so the two-tiered approach is to help us put our maximum position size on every entry and reduce the draw in the portfolio for this very simple fact. The best trades never challenge the stop. You hear me say this over and over and over again. I invite you to go look at all of your own trades, go look at your biggest successful days, and go look at your entry. I guarantee you that entry was powerful, and the asset never went down to challenge the stop. It doesn't even blink. You buy it and it rips higher. You know those days. You know what I'm talking about. Okay. So the object with the two-tiered approach is to put your position on at the trigger bar. The minute the asset goes below the low of the trigger bar, that could be the very next bar, you cut the position in half. Then you carry that half to the original stop, which is what we're going to call the low of the move we're buying. Let's go take a look just to put it into a visual that you can understand. Okay. Let's look at yesterday's action. I'll blow it up for you. Okay. So the entry point is here, this yellow bar right here. Okay. Which takes us, it marks the double bottom over an hour and a half period. It's a reversal bar. That's what the yellow means. It closes back above the first standard deviation below the VWAP, which is the buy trigger, the ARMR buy trigger. It's one of my favorite triggers. I mean, it works a high probability. I mean, a high degree of the time this trade works. Even on a horrific day like yesterday, it worked. Okay. So an hour-long base that sets up, pops above the first standard deviation below the VWAP. That's your trigger bar. Okay. So there's two stops on this. First of all, you want to put all your capital to work on the very next bar because this bar has to close. And so you're executing on this bar. Okay. So the trigger bar is here. So obviously the low of the trigger bar is the low of the trigger bar. It's not hard to understand. All right. And in this case, the low of the move is the bar before, which is the reversal bar. Now, this is very close, so this would be easy. You'd cut half right here, and another half if it closes below here. So that's very close. But let me take you to to Fed Day, because that's a little bit more hairy, and you'll get an idea of what I mean. Let's take you to Fed Day, okay? So Fed Day, we don't trade in the morning. We've gone over that. This is the reaction to the Fed, the huge up bar. We don't trade that bar because that's just a knee-jerk insanity. Then there's the sell-off, okay, right in here. So let's go over. Let me blow this up for you so you can see this as clear as day. All right. The first stop is the low of the trigger bar, which is right here, that green bar. It pops back above key gamma level, which was the vol trigger, I think, at the time. It holds the first standard deviation above the VWAP. Notice the first standard deviation above and below are key trigger points for the ARMR report. All right. So the first stop is the low of this bar, and the final stop would be the low of the tail, because the move you're buying is this reversal, and the trigger you're buying is that move higher. So the first thing you do is you immediately cut the position in half if it takes out that low. And you might give it a little bit of room because it was a wild volatility day. So you might see a tail and you say, okay, well, I don't want to get shaken out on a tail. So I'll cut half when it takes out that low. And if it takes out the low of this reversal bar, then the trade's over. Okay. So those are my 3 rules for you to try to improve your own performance. Take them and see if they apply to your own trading process. I don't know how you trade, so this might not apply at all. Okay. But whatever your trigger bar is, if your trigger's worth anything, then the best trades will never go below that bar. So if they do, in some cases, you could sell the whole position. Okay. But in other cases, the reversal bar is the bar you want to use as your stop, because there's every now and then you'll get a tail, right? The market will wiggle down and you don't want to cut your whole position because it'll wiggle down, reverse, and skyrocket the rest of the day. Okay, you'll have half your position on. But what we want to do is overweight our trading portfolio to the days that never challenge the stop. And that's what the 2-tier strategy does for you. So those are my thoughts for today. I'll be out there doing research. I'll be out there looking at new ideas. We did some research on Playboy yesterday, and I think that's a major metaverse idea. I want to thank the ARMOR Insider who brought that to my attention. So just because I'm doing research doesn't mean I'm buying it. I do research, goes on the whiteboard, watch how it trades, look for entry points. But when I listen to that Playboy conference call, it feels like the metaverse is a natural fit for that business. You talk about NFTs. This company has a vault of photographs that they could turn into NFTs. I mean, it's just very interesting what the company's doing. So anybody has an interest in that idea, go listen to that conference call. All right, any questions you have, and I'll be happy to answer them before we jump over to the ARMOR Live trading desk. So I'll try to hit these quick. What do you think about CCL disclosure? I'm long. Question. Okay, let's take a look. All right. First of all, just a quick review of the market itself, right? So we took out the lows of the risk monitor red day. Now we're going to try to rally off of those lows. But obviously this is a top that's formed. So you could see when you look at these charts that one up day, one up morning wouldn't change anybody's strategy. It's just not a strategy changer. You know, here's a double top on the S&P that challenged the uptrend and held. It's going to go close that gap. That's totally normal. Gap close. There's 2 gaps the S&P has left behind. So gap closures are normal. That rally doesn't change what's going on in the overall broader market. Okay, certainly Russell's trying to hold that trend line. It goes back 11 months. Okay. So going to CCL, I see the Carnival Cruise chart pattern, and that's a clear double bottom. I get why you're interested there. I'm not going to give you an opinion on what I think about the cruise industry. I'll just look at the chart with you and say, if I was buying this, I could see the reason you would buy that. And of course, the low of yesterday would be the stop, right? Because there's a double bottom you're hoping on rising volume, right? With a nice close. So there's your trigger bar, perhaps. Okay. And so the low of that bar is your stop. And following the strategy of day trading also works for swing trading and investing. You know, the best trades won't touch the low of the bar you're buying. So you could theoretically stop out half the position if it goes below there. And depending on the type of investor you are, you're going to either use the low of the move, which is that reversal hammer right there, or the low of the structure, right? Which is this low right here. The structure is a double bottom. The move is that reversal, and the day you're buying is the trigger. So those are the three stop areas that I use when I'm putting a new position on. My favorite way to express the economy reopening and fears of viruses subsiding is Airbnb. That's just, for my own 2 cents. I don't like that chart pattern, but I'm just sharing what my favorite name is there. All right. Morning, everybody. All right, great. Any questions, insiders? Anything you got for me? Please add the research department. All right. SGH, this is coming in from an ARMR Insider. Erez, one of our best. One I would consider an ARMR analyst, part of the army of analysts. That chart pattern looks great. So we'll do some research on that today. And CRUS, Cirrus Logic, that looks pretty good. And I think what we have to do, Erez and everybody on the live trading desk, is listen to that Micron call, right? Because that chart looks great and they had a decent earnings number. Look how that's going to look at Pure Storage. That thing just doesn't want to quit. All right, let's see if there's any other questions you got for me out there. Gold and silver up a little bit. That's nice. Since we added recently our gold and silver positions back to the portfolio. All right, I think we're done for the day. We're done for the morning. All right, so you know what our marching orders are from a trading strategy. We get a gap up and run higher that starts to fail. We'll look for triggers to get short. We get a gap up that immediately sells off, tests lows, and sets up a bottom. We'll be looking to go long because our day trading strategy doesn't care what the swing or the investing or stalking bear market doesn't make a difference. We trade what we see. We go to our playbook, say, is this the setup? If it is, we put the trades on. All right. So we'll be focused on that. I wish you all a great trading session. Don't forget to stay nimble. Don't force your will on the market. Trade what you see. I'll see all of you tomorrow, 8:30, 8:45, whenever I get started. And all the ARMR Insiders will move over to the Slack room and start our live stream for the screen share and our trading desk. All right, guys, take care. Have a great day.